Hello everyone, welcome to the 52nd video of me learning how to trade in Forex. So in the last video we went through where does Forex broker's price come from. We read through all of this, made some notes, and now, so here are the notes we've made, and now we're on what is Forex broker's order execution quality. So let's get started. What is the Forex broker's order execution quality? Date is 22nd, 02, 2024. So it has been a while since I've done my last episode, but I think we'll be able to catch up when we read through all of this. So, what is the quality of your broker's order execution? Order execution is a process of filling the requested buy or sell order of the trader. In the previous lesson we talked about the prices that the Forex brokers show you on their trading platforms, whether the prices are fair and accurate. But having fair and accurate pricing on your trading platform means nothing if your trade hardly ever executes at the shown price. It's like visiting a bakery and being shown a photo of a cake they offer. You like how it looks, so you order it, but when you get it, you discover that the baker wasn't able to actually execute and create the cake that you requested. What was ordered? Very nice. What was executed? Even nicer. What you see above is an example of poor cake order execution. It's important to find a broker that is committed to execution quality and transparency. In other words, the broker should be committed to treating you fairly when it executes your orders. Let's revisit a part of the earlier story of Batman and Spider-Man. I'm betting that will go up from 1.4100, his current price. Here's my $20, open the bet. Spider-Man suddenly Spidey senses that GBP USD will continue to rise, so he tries to stall by pretending not to hear Batman. Hello, did you hear me? Unlike snakes, spiders aren't deaf. Here's my $20, open the bet. What was that? So you do want to open a bet? My price for GBP USD has changed. It's at 1.4150 now. You still want to make a bet? Dude, what the hell? I thought you said GBP USD was at 1.4100. Now you changed the price all of a sudden? That's my new price, so are you in? Better hurry before I change my price again. Fine, I'm in. I bet it will go up from 1.4150. Notice how Spider-Man originally offered to fill Batman's order at 1.4100, but then all of a sudden changed the price to 1.4150. Batman was slipped by 50 pips. That ain't cool. If you're not familiar with the story above, this means you haven't read our earlier lesson on how Forex brokers kinda work, where Batman and Spider-Man make guest appearances. It's highly recommended that you read this lesson first. What is your broker's order execution policy? Forex brokers should provide clear disclosure to customers about how their orders are executed. It should be able to provide a document that's usually called order execution policy. So, Forex brokers should provide clear disclosure to customers about how their orders are executed. They should be able to provide a document usually called order execution policy. This document summarizes the process by which their trading platform executes your orders to obtain the best possible result for you. Having an explicit order execution policy, so you know how your orders will be handled, should be seen as a prerequisite before further evaluating a broker. You should look for the following: the process followed for selecting the price sources used by the company. So, should look for the following: process followed for selecting the price sources used by the company. Shouldn't do another bullet point. Process for selecting the hedging counterparty or liquidity providers for the customers' trades. The process for selecting and monitoring the technology used for executing customers' orders. Process for selecting and monitoring the technology used for executing customers' orders. How the company manages any potential and actual conflicts of interest arising when executing customer orders. How the company manages any potential and actual conflicts of interest arising when executing customer orders. Once you've read and understood their policy, there's more homework to be done. Here are some questions to ask your broker to help you evaluate the quality of their order execution. How committed is a broker to order execution quality and transparency? How automated is their execution process? What is the average spread per currency pair? How fast are trades executed? What is the average execution speed? What percentage of orders are executed with slippage? What percentage of trades are successfully executed? What percentage of orders are executed with positive slippage? What percentage of orders are executed with negative slippage? So, potential questions to ask the broker to help evaluate the quality of the order execution. How committed is the broker to order execution and transparency? I assume the answer for this one is most brokers are going to say, oh, we're doing our best to make our orders as transparent and as accurate as possible, but I don't know, we'll see. How automated is their order execution process? What is the average spread per currency pair? How fast are trades executed? What is the average execution speed? What percentage of orders are executed with slippage? What percentage of trades are successfully executed? What percentage of orders are executed with positive slippage, and what percentage of orders are executed with negative slippage? So, what percentage of orders are positive slash cool. How committed is a broker to order execution quality and transparency? Brokers who are committed to fair pricing and quality order execution prove it by being transparent and publicly disclosing execution statistics. Who are committed to fair pricing and quality order execution prove it by being transparent and publicly disclosing execution statistics. These brokers regularly publish execution data reports, which include stats like average execution speed, average spreads, percentage of spreads executed at the requested price, no slippage, and percentage of trades executed with both positive and negative slippage. These reports are usually published on the broker's website. If you can't find it, contact the broker and request it. Aside from order execution reports, how transparent are they about their order execution process? Do they disclose the following? These could go into the questions. So, who are the liquidity providers? What percentage of volume does each liquidity provider provide? What percentage of volume does each liquidity provider provide? Does it disclose any close links, conflicts of interest, or common ownership of any liquidity providers? Disclose any close links, conflicts of interest, or common ownership with any liquidity providers. Does it disclose any specific arrangements with any liquidity providers regarding payments made or received, discounts, rebates, or non-monetary benefits received? Does it disclose any specific arrangements with any liquidity providers regarding payments made or received, discounts, rebates, or non-monetary benefits received. Does it provide an explanation of how order execution differs according to different customers, where the broker treats categories of customers differently? So successful traders and unsuccessful traders, basically. Provide an explanation of how order execution differs according to different customers, where the broker treats categories of customers differently. Isn't it like called like bias something? Bias. I think it's called something bias. Because I remember reading like in one of the previous lessons, it's like if the customer's successful or something, it like A books your trade. But if the customer isn't that very good at making, or isn't very good, or isn't very successful actually, then they'll B book the trade or something. So something read about before in one of the last lessons, I think, or previous ones. Yeah. If they can't provide one or mention that such data or information isn't made public, then you might want to move on and choose a broker that is more supportive of transparency and fairness in the retail forex industry. How automated is the order execution process? There are shady brokers out there that manipulate order execution conditions in their favor. Can your broker explain to you their process in executing orders? Is the entire process automated? If not, can they specify scenarios where manual intervention is involved? What is the average spread per currency pair? On its trading platform, the broker quotes two prices: the higher price, aka ask, at which you, the customer, can buy, go long; the lower price bid, at which you, the customer, can sell, which is go short. Both prices are collectively referred to as the broker's prices. The difference between the bid and ask price is the spread. Normal spread, so like around 2 pips. Wide spread, around 20 pips. What is the average spread per currency pair made available to the broker's customers? Can data on spreads be broken down by hours? For example, what is the average spread per currency pair during all trading hours? What is the average spread per currency pair during peak trading hours? What is the average spread per currency pair during non-peak trading hours? So, all trading hours, peak trading hours, non-peak trading hours. How fast are trades executed? How fast are trades typically executed? This is also known as execution speed. Execution speed is defined as the amount of time between when the broker receives your order until execution. So number one, the broker gives you a quote, the trader then sends the order, and the broker then executes the order, or sends out an order execution confirmation. The faster the speed, the more volume of trading that can occur. More importantly, the faster the speed, the more chances for the broker's customers to be able to buy or sell at the price that they have requested. Ask the broker where their average execution speed is. Ideally, it should be 0.1 second or 100 milliseconds or less. So, broker's execution should be 0.1 seconds or less. Also, ask what percentage of trades are executed in less than 1 second. What percentage of trades are executed in less than 1 second? If orders are taking more than 1 second to execute, you're most likely going to experience slippage because prices have changed before your order completes. Prices in the Forex market can move in milliseconds, so if the broker's execution speed is too slow, the price you clicked on to trade on may have changed by the time the broker can execute the order. What percentage of orders are executed with slippage? When you see a price on your broker's trading platform and want to trade on that price, your broker is supposed to exert every effort to fill your order at that requested price. When executing orders, the broker has an obligation to take all sufficient steps to obtain the best possible results for their customers, taking into account multiple factors. This is known as striving for the best execution. Ideally, obtaining the best possible result means you get the price that you requested. But whilst the price is the most important factor when considering the best execution, it's not the only factor. This means that the price you wanted may not be the price your order is executed at. Whenever you are filled at a price different from the price listed, it's called slippage. So here's a candle bar chart again. Top bit, you place a sell order this low, but the price gaps a lot. Your order is filled at the next available price. Price is filled here, open, and this is a slippage because the price you wanted to sell at is here, but then you actually have to sell it here. Traders typically focus more on the spreads, whilst largely ignoring slippage unless the slippage is blatantly obvious when one of the orders is filled. Slippage isn't necessarily something that's bad because any difference between the intended execution price and actual execution price qualifies as slippage. Market prices can change quickly, allowing slippage to occur during the delay between a trade order being processed and when it is completed. Slippage can occur for many reasons, but price volatility is often the biggest reason. As price volatility increases, slippage, both positive and negative, occurs more frequently. As price volatility decreases, slippage occurs less frequently. So, price volatility increases, slippage occurs more frequently. As price volatility decreases, slippage occurs less frequently. This is why traders typically see more slippage during high periods of volatility, such as during breakdown news or economic data releases, or when a former US president used to fire off a random tweet before his account was suspended. Under normal market conditions, if your broker cares about execution quality, occurrences of slippage should be infrequent and the magnitude of slippage should be minimal. What percentage of trades are successfully executed? Successful order execution is when the order is executed and the requested price at the requested price or better. So, ask price 1.1050. Order placed to buy at 1.1050. Order executed at 1.1050. No slippage. So exactly what the trader wants. This can be further broken down by market and limit orders. What percentage of market orders are filled at or better? What percentage of limit orders are filled at or better? When an order has been executed, it is referred to as being filled or a filled order. Market and limit orders can be used as entry orders that open up new positions and closing orders that close an existing position. A market order is an instruction from a trader to their broker to execute a trade immediately at the best available price. So, market order is an instruction from trader to the broker to execute a trade immediately at the best available price. Limit order is an instruction to execute a trade at a level that is more favorable than the current market price. Wait, so let me just read that again. When an order has been executed, it's referred to as being filled. Market and limit orders can be used as entry orders and closing orders. Yep, market orders are instruction from a trader to their broker to execute a trade immediately at best available price. So like currently, like buy now basically. A limit order is an instruction to execute a trade at a level that is more favorable than the current market price. So this is like buy later, or sell later, or sell now. This is sell or buy now at the current best available price. This is when you want to buy at a different market price, basically. I think limit orders allows you to specify the minimum price at which you will sell or the maximum at which you'll buy. Allows you to specify the minimum price at which you will sell or the maximum price at which you will buy. What percentage of orders are executed with positive slippage? Positive slippage, also known as price improvement, occurs when your order executes at the more favorable price than the price you requested. The opposite of a price movement is negative slippage, which is when your order executes at a less favorable price. Can the broker tell you the percentage of executed trades that were executed at a more favorable price than the price of their customer requested? Now, what is the average positive price improvement per order in pips? This is defined by the pip difference between the requested and executed price orders with the improved price. Orders can also be further broken down by market and limiting orders. What percentage of all market orders are filled at a more favorable price than requested? What percentage of limit orders are filled at a more favorable price than requested? For example, let's say you want to buy Euro USD immediately. You hop on your Forex broker's trading platform and see the price of 1.1050 been displayed and clicked buy. So the broker asks for 1.1050. Yeah, you place the order to buy at 1.1050, but then broker actually sells it to 1.10, sells you it for 1.1049. So 1.1050 is the price you wanted and your market order to be executed at. The order is submitted and you receive a confirmation that your buy order was filled at 1.1049, 1 pip below your requested price. Because the order was filled at a better price, 1.1049, than you requested, 1.1050, you experienced positive slippage of 1 pip. Positive slippage of 1 pip. What percentage of orders executed with negative slippage? Negative slippage is when your order executes at a less favorable price. Shady brokers have software that allows them to sneakily slip traders very small amounts on every trade order. It's like death by 1,000 cuts where traders don't realize they're losing a couple of pips on each trade. This is why you ask about their negative slippage stats. Can the broker tell you what percentage of executed orders that were executed at a less favorable price than the price of their customers requested? What is the average negative price improvement per order in pips? This is defined by the price difference between the requested and executed price of orders with the inferior price. What is the average? What is the average negative price per pip per order pips? This can be further broken down by market limit and stop orders. What percentage of market orders are filled at a less favorable price than requested? What percentage of limit orders are filled at a less favorable price than requested? What percentage of stop orders are filled at a less favorable price than requested? For example, let's say you are trying to buy EURUSD at a price of 1.1270. So on your trading platform, you enter a limit order of a price of 1.1270 and click buy. So you the broker asks for 1.1270, you buy at 1.1270, but then the order is actually executed at 1.1273. That's a negative slippage of 3 pips. So the 1.1270 is the price you wanted your limit order to be executed at. The order is submitted, and a couple of minutes later you receive confirmation that your buy order is filled at 1.1273, 3 pips below your requested price. Because the order is filled at the worst price, 1.1273, than you requested, 1.1270, you experienced a negative slippage of 3 pips. If traders do check and see what spread and slippage they receive on a trade, it's typically when the trade is opened, and then they don't bother or forget to check it when the trade is closed. Shady brokers are aware of this way. If traders do check to see what spread and slippage they receive on a trade, it's typically when the trade is opened and they don't bother or forget to check when the trade is closed. Shady brokers are aware of this. Since they know you're probably watching when you open a trade, they'll sit tight and won't interfere. But when the order is closed, this is when they'll sneak in the extra slippage. Right. Are you suspicious about why your order wasn't executed at the requested price? Brokers may have the ability on their trading platform to control and add slippage and or delay the execution of your order, so you end up getting filled at a worse off price. For example, brokers can deliberately introduce negative slippage into order execution where if price benefits the broker, it will execute. But if the price does not benefit the broker, then the price is slipped and requoted with another price that favours the broker. If you're suspicious about why your order wasn't executed at the requested price, you can request a post-trade execution report. If you're suspicious about why your order wasn't executed at the requested price, you can request a post-trade execution report. Upon request, your broker should be able to provide you within a reasonable time frame documented evidence which determines clearly that it executes your order in accordance with its order execution policy and information about its order execution arrangements. For example, in the US, retail Forex traders are required to provide their customers upon request with certain order execution data. This includes price data for the 15 transactions in the same currency pair that occurred immediately before and after the customer transaction. This allows their customers to verify that prices offered closely mirror that the prices offered closely mirror prevailing market prices. The bottom line: Forex brokers operate different order execution methods, none of which is right or wrong. What makes a broker good or not has little to do with A book or B book, but rather how the company conducts its businesses. Don't assume that mentions of A book, STP, or straight-through processing, or ECN are attributes of a good broker. An A book broker can still go against their customers' interest as easily as a B book broker can. Any broker can withhold deposits, give poor pricing, manipulate order execution processes, and lie to customers. Regardless of the execution method of a forex broker, what ultimately matters is that the broker provides transparent prices that closely track the real institutional FX market in real time, and fills orders at requested prices without delay. You want to select a broker who is honest about the risks and hazards of leverage trading, is transparent about its pricing policy, is clear about how it executes orders, processes withdrawals in a timely manner, has robust risk management policies, is adequately capitalized so it can't go bust, has a formal process for handling customers' complaints that's quick and fair, is licensed and regulated in multiple jurisdictions, especially where you live. Ideal broker is honest about risk and hazards of leveraged trading, is transparent about its pricing policy, is clear about how it executes orders, process withdrawals in a timely manner, has robust risk management policies, is adequately capitalized so it can't go bust, is adequately capitalized so it can't go bust, has a formal process for handling custom complaints that's quick and fair, has a formal process for handling customer complaints that's quick and fair, is licensed and regulated in multiple jurisdictions, especially where you live. And regulated in multiple jurisdictions, especially where you live. Jurisdictions capitalized about. If a broker doesn't provide clear information about all of the above on their website, contact them directly and ask them. If your broker declines to answer any of your questions, ask why. Be suspicious of any broker that believes it is above scrutiny. Always consider how a broker actually operates before depositing real money and opening live trades. Okay. Statistics, field, report. I think I'm going to leave this episode here because in this one it looks like we're going to be covering something basically completely different. So yeah, because in the previous lessons we've done mostly about the Forex brokers itself and learn how they work. But now this is like actually learning how to trade, I guess. So 3 types of Forex market analysis: technical, fundamental, and sentiment analysis. So yeah, we've done the technical and fundamental stuff, but I don't think I've heard about sentimental analysis yet. So yeah, very good. So in the next video we're going to go through 3 types of Forex market analysis, and yeah, we'll make some more notes on this. So thank you guys for watching, and I'll see you in the next video. Peace.